I was obsessed with the game of cricket during my school days, and I was a reasonably good player, so there was a chance to represent my school in a match against a visiting South African under 19 side. And I was pushing hard to secure a place in the final 11 for our team. I played as a leg spinner, and if you've ever bowled leg spin, you know it's a bowling style that dances on the edges of brilliance and disaster. I often struggled during practice matches and net sessions. One delivery would turn sharply, the next would land halfway down the pitch and disappear into the trees. So some days I felt unstoppable, and most other days I felt like I did not belong. After one particularly frustrating session, I told my cricket coach I was thinking of giving up. And I said, maybe I am just not cut out for this. He looked at me and he said something I did not fully understand back then. He said, you don't walk away just because it's hard. You stay the course. You signed up for this. And the long road is the only road worth taking. Well, I stayed the course and ended up playing for my team. We lost the match, but I played, and I think I played reasonably well. I didn't know it then, but my cricket coach's words would return years later to help me. Not in the middle of a cricket field because I stopped playing after school, but while watching my investments go through upheavals during market crashes. And there have been several during my 22 plus years journey as an investor so far. Welcome back to the Inner Game. Today I want to talk about something that every long-term investor inevitably encounters. And not just once, but many times over the years. It's not some exotic strategy or some secret metric. It's not about timing the market or finding the next multi-bagger stock. Not at all. What I want to talk about is far less glamorous, but infinitely more powerful. It's the mindset of staying the course when things go wrong, as they always do. See, when you first start investing, you're often filled with hope. You read books, you listen to advice, you look at long-term charts, and you see the beautiful upward slope of compounding. It's seductive, to say the least. It gives you the impression that wealth building is just a matter of discipline and time. It's a calm, rational pursuit. And for the most part, that's true. But what those upward sloping charts don't show you, or at least don't emphasize enough, it's a cost. And I'm not talking about the financial cost in terms of brokerage fees or taxes, but the psychological and emotional cost of enduring the long journey. You don't earn a 12 to 15% annual return by sitting back and sipping a cup of tea or coffee while the market slowly climbs. You earn them by withstanding multiple 30 to 40% or even more drawdowns, by holding your nerve when everyone around you is losing theirs, and by resisting the overwhelming urge to do something, just anything, when inaction is the hardest choice of all. The cost of compounding is not paid with money. It's paid with discomfort. It's paid with uncertainty and sometimes a touch of despair. But if you can bear that cost, the rewards over the long term are extraordinary. Right now, if you're an investor in stocks, there's a good chance you're not feeling very optimistic. Perhaps your portfolio is down 20 or 30% or maybe more. You're opening your app, you're seeing red across the board, and you're asking yourself questions that swing between anxiety and doubt. Should I sell and get back in later? Or should I move to cash and wait this out? Maybe this time is really different. Now, these aren't signs of weakness. They're signs that you're human. Because no matter how much we intellectualize investing as a rational game, when the market tumbles, emotions spill into our thoughts and fear becomes louder than logic. But this is the moment where the real inner game begins. Because the truth that every wise investor understands, it's that volatility is not a bug in the system. In fact, it is the system. The stock market does not deliver returns in a straight line. It never has. The journey of investing is messy, it's jagged, it's unpredictable. And there are long stretches of stagnation. There are stretches of sharp falls, sudden recoveries, and slow climbs. The market tests your beliefs not just in the economy or your investments, but in your own ability to stick with something that feels like it's punishing you. Now, let me be very clear here. Staying the course does not mean ignoring the risks or blindly holding on to bad decisions. It doesn't mean pretending that everything will always work out if you just hope hard enough. Staying the course means understanding that market cycles are normal, that fear is part of the process, and that acting out of panic is usually far more damaging than staying invested through tough times. It means having a plan, a well thought out strategy that includes asset allocation, diversification, and regular rebalancing, and sticking to that plan even when the world feels like it's falling apart. I've been investing for over 2 decades now, and if there's one pattern I've noticed, it's this. Every major market crash looks different on the surface, but underneath, it evokes the same emotional reaction. Whether it was a dot-com bust of 2000, the 2008 financial crisis, or the COVID crash in 2020, or the current correction, the core feelings are the same, and they are of fear, regret, anxiety, and a desire to act. Each time, there's a new narrative, a different reason why this time is different. But the emotional cycle is constant. And unless we train ourselves to see through the noise, we get caught in the same trap again and again and again. Now, one of the most important mental shifts in investing is learning to reframe volatility. Most people see it as risk, but I've learned to see it as opportunity. Volatility is the market offering you stocks which are ultimately slices of real businesses at cheaper prices. But to take advantage of that, you have to stay in the game. And you have to be emotionally equipped to see falling prices not as dangers, but as chance to invest in the future at a discount. Just think of it this way. When a great company's stock is down 30 or 40%, you're essentially buying its future earnings at 30-40% discount. But most people don't see it that way because they're too busy reacting to the immediate plan. They forget that the long-term value for business has not changed just because the market is going through a phase of pessimism. In fact, some of the best investments are made in times of widespread fear. And not because fear is a good thing, but because it distorts prices and creates opportunities. But that only works if you're still holding those investments. It only works if you haven't sold everything and moved to cash, waiting for some imaginary all clear signal, which, by the way, never comes. There is no bell that rings when the market hits the bottom. You don't get any notification saying, now is the time to buy. The recovery begins quietly, often when sentiment is still negative. And if you're not in the market when it turns, you miss out on the rebound, which is where a large part of long-term returns are made. Let me now share a few practical reminders that have helped me through tough markets over the years and that might help you now. First, it's very important to resist the urge to act just for the sake of doing something. When everything around you feels uncertain, doing nothing feels irresponsible. But in investing, the hardest action is often inaction. Sitting on your hands when every instinct tells you to flee takes real strength. But it's precisely this stillness that protects your compounding engine. Second, stop checking your portfolio so frequently. If your investment horizon is 10 years or more, why are you checking daily price movements? What are you hoping to find? The more often you check, the more likely you are to feel compelled to act. And as we've established, that action is rarely helpful. Third, turn down the noise. Financial news is not designed to help you make thoughtful decisions. It's designed to keep you engaged. And nothing engages more than fear. Every headline screams urgency. Every anchor sounds alarmed, but most of it is just noise. So don't let their panic become your plan. Fourth, very important, focus on your process. A good investment process does not guarantee short-term success. It guarantees resilience over time. You will have periods where your portfolio underperforms, where your convictions are tested. That doesn't mean your process is broken. It means markets are doing what they do. Fifth, speak to your past self. Think back to the version of you who invested in calm times. What was your plan? What was your reasoning? What did you commit to? Would that version of you want to exit the market in a panic today? Probably not. And that's the version you should trust. And finally, zoom out. When in doubt, always zoom out. Look at a 10 or a 20 or a 30-year chart of the stock market. You'll notice something remarkable. The biggest crashes and corrections, which felt catastrophic in the moment, they're barely visible in a long-term chart. They're just tiny blips on a much larger upward trend. And that perspective is everything. And finally, the kicker, nobody ever promised you a smooth ride. That illusion that markets only go up and that smart investors always win, is a fantasy sold by those who benefit from your restlessness. The truth is that even the best investors have seen their portfolios drop by massive amounts, sometimes by 50% or more. But they stayed the course. They did not sell their best businesses just because the market lost its head. They trusted their process and kept going. And that's why they compounded wealth over decades. So if you're feeling anxious right now, let me say this: it's perfectly okay. You're not weak. You're not a bad investor. You're just human. But don't let that anxiety drive the ship. You can acknowledge it, you can observe it, and let it pass like a cloud in the sky. But your actions must come from a deeper place, from a place of clarity and commitment. If your financial goals haven't changed, your investment strategy probably should either. And if your plan was built for the long term, it should have accounted for this, for the drawdowns, for the corrections, for the rough patches, because tough times are not the exceptions in investing, they are the rule. So finally, what do? We stay the course. We accept that this discomfort is part of the deal. We stop looking for shortcuts or magic bullets. And we remember that long-term investing is not about brilliance, it's about endurance. To anyone listening who feels shaken right now, I want to leave you with this final thought. A market crash is not a glitch in the system. It is the system. And the way through is not to avoid it. The way through is through it. So take a breath, take a step back, and remind yourself, gently but firmly, that this is what I signed up for. Thank you for joining me today on the Inner Game podcast. If this message helped you, please consider sharing it with someone you care about. Because we all need reminders in moments like these, and sometimes all it takes to stay the course is to hear a voice that tells you that you're not alone and you're on the right path. Until next time, stay grounded, stay thoughtful, and above all, just stay the course. Thank you so much.